check, 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 check. Check, 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 check.
แอนดรูออเซนค่ะแล้วก็กมลยศค่ะแล้วก็พัทรชัยพัชรชัยโอเคค่ะอันนี้แค่พูดไกลๆฮัลโหล
ใช่ถ้าเกิดว่าจะไม่ได้พูดกับใช่ครับ
เฟซชิลอยู่ตรงไหน
ไปชิวไปชิว
ฮัลโหล
คุณจะได้
ไม่ได้
ทำแบบตรง
ต้องอย่างงี้เหรอฮัลโหลค่ะก็คือเมื่อกี้นี้ได้แล้วค่ะไม่ต้องเสียค่ะ
ๆโอเคได้ครับ
มาพูดข้างหน้านี้ก็ค่ะเราไม่
Good morning, ladies and gentlemen. My name is Suthirat Hong Thong. I'm Society Manager of CFA Society Thailand. I would like to welcome all of you to the CFA Institute Research Challenge in Thailand 2020 to 2021. The Research Challenge is a global equity research competition among teams of students organized by CFA Institute. There are more than 1,000 universities from around the world participating each year. For the local level this year, we arranged the competition with PTG Energy Public Company Limited as a subject company. At the end of today, we will select the best team who will represent our CFA Society Thailand to compete with other teams in regional and global rounds. Due to social distancing requirements during COVID-19 pandemic, we have limited our participants, and our event today will be live on CFA Society Thailand and CFA Institute Research Challenge Facebook page. On behalf of CFA Society Thailand, we will not be able to make our event happen without our main sponsor, including Kiat Nakin Patara Security Public Company Limited, the Stock Exchange of Thailand, Bloomberg, and Kaplan Schweitzer for their kind support. Before we begin our final rounds, please join me in welcoming the President of CFA Society Thailand to give us an opening speech. Please welcome Kun Win Prompatค่ะ
Mr. Andrew Stotts, past President of CFA Society Thailand, panel of judges, faculty members, students, ladies and gentlemen. Every year, over 6,000 students from 95 countries participate in CFA Institute Research Challenge. They work in teams, assume a role of research analysts, and then they judge us on their ability to write and value stock, either buy, a hold, or sell, write a research report, and present their recommendations. The winner of today will represent Thailand in the Asia Pacific round, whereas the regional champions will compete in the global round later in April. In 2011, a team from Thammasat represented Thailand and became an Asia Pacific champion. A year later, another team from Thammasat went all the way to become the world champion in New York. It's been quite a long time ago, so I hope that a team from Thailand will make history again this year. This research challenge activity forms one of the key missions of CFA Society Thailand, which is to develop future professionals. My advice to all the students today is that it doesn't matter much which one of you will become today's winner. But what matters is that all of you have learned the real-world experience of how to analyze the company, write a research report, and defend your investment thesis. You also learn lots of skills like teamwork, data analytics, and presentation. All the skills you have learned today are your very first steps towards becoming a finance professional. So who knows, one day I will see you again as a research analyst, a fund manager, or a CEO. I'll wait to see that proud moment. On behalf of CFA Society Thailand, I want to thank the management of PTG Energy Public Company Limited, who have been kind to share the information via subject company. I also thank the sponsors, Kiat Patra Securities, Bloomberg, Kaplan, and the Stock Exchange of Thailand. Thanks to the professors and the mentors who have dedicated their time for training. And thanks to all the judges who are going to be making tough decisions today. So I wish all of you here all the best. Have fun and good luck. Thank you.
Thank you, Kun Win Prompatค่ะ for your inspiring welcome speech. Next, we will go over the rules and introduce you to our judge. Kun Cherry Lalada will take it from here. Please welcome.
Good morning, judges, professor, CFA board member, volunteers, and our guests. I am Lada Opaterkun, the organizers of this year's research challenge and your moderator for today. This year, 14 teams from 9 universities participated in our program, but only 4 teams who got highest score in the research report and presentations during the semi-final rounds advanced to this final round. We're looking for not only a good writer, but also a team who has an ability to present their analysis and idea to the audience, answer the challenging questions, and represent us in the regional and hopefully the global round. The format of our local final round is similar to the regional round. The final 4 team will be presenting the presentations and analysis to panel of judges who give them a score. The team who gets the highest presentation score will be the winner and represent CFA Society Thailand in the virtual regional round. Before I start, I would like to introduce our honorable judges who are highly respected financial professionals in Thailand. First, Dr. Andrew Stott, CFA, CEO of A Stott Investment Research and former president of CFA Society Thailand. Second, Kun Arsen Kanburisut, Head of Equity Thailand, Aberdeen Standard Asset Management. Third, Kun Kamonyot Sukhum Suwan, Senior Portfolio Manager, Asset Platform Management. And last but not least, Kun Patcharachai Puttikun Satit, Investment Analyst, NT Asset. They're all volunteering their valuable time to our event today. Thank you very much. Now, let's go over to the rule of presentations. Each team will have a total of 10 minutes for presentations and another 10 minutes for Q&A sessions. When there is 1 minute left, the team will see the sign like this, and another sign when the time is up. Same rule apply to the Q&A sessions. We will also spare 5 minutes after Q&A sessions for judge feedback so that you can improve your future presentations. And this section will not be scored. We'll call each team by its assigned number, not the university name, to ensure the unbiased judgment. We want to also ask all audiences not to review any signs indicating the university name while the team is presenting. Also, in order to avoid the distractions to the presenters and judges, we would like to ask for your cooperations to please be quiet during the presentations and keep walking in and out the room to the minimum. Also, please turn off your mobile phones. อันนี้ขอย้ำนะคะกวนปิดโทรศัพท์มือถือแล้วก็พยายามอย่าเดินเข้าออกในห้องนะคะ Okay, so now it's about the time. Can all participant team leave the room so that we can begin the first presentations? But Team A, please stay. Hello.
Hello. Hello.
Okay, let's begin with our first team, Team A. You can start whenever you're ready, and we'll start the time when you begin presenting.
If you are looking for a valuable stock to invest in, there is one long-standing company that has a strong business fundamental and continuously improve its operation. It stands strong amid the pandemic, and this is PTG, the Thailand's leading comprehensive energy provider. Good morning, respective judges. We are Team A, and today we issue a buy recommendation on PTG stock with a target price of 20.6 baht, presenting 30% upside. PTG has operated 7 business units, mainly oil and retail, LPG retail, and food and beverage. Its target customer is commercial vehicle. For the 9-month revenue, oil business contributes for 96% of its total revenue, driven by marketing margin, while the non-oil revenue contribute for 4%. But why PTG deserves a buy recommendation? There are 3 key reasons. P, for prominent fundamental. T, for thriving margin expansion. And G, for growth opportunities to capture. Now let's look into the first reason. PTG has continuously improved its operation as well as expand its store expansion with a strategic location along the minor roads, which enable the company to differentiate itself from other competitors. And by acquiring and renovating old service station, PTG can reap the benefit from lower capital expenditure. Also, the company has invested in 10 tank farms spanning across the country, as well as its own logistics system, which can shorten delivery time and lower transportation costs by backhaul. Moreover, PTG has a joint venture in PPP Green Complex, which is the first fully integrated palm complex in Thailand. The increasing sales of biodiesel will enhance PTG bottom line through shares of profit from associates. These superior vertical integrations have made PTG outstanding from its peers. First, PTG is in the first rank in terms of number of service stations, with the lowest inventory day. Moreover, PTG is the only company that can maintain positive oil sales volume growth during the pandemic, proving that it is resilient to shocks. And the historical data also shows that PTG has maintained and continuously improved its performance with an increasing revenue and net profit margin, positive free cash flow, hence result in a high dividend payout ratio. Next, my colleague will walk you through the second reason.
PTG not only has a strong historical performance from its main business, but it also expands its portfolio into LPG and also non-oil business such as convenience stores and food and beverages. As oil price fluctuated, incorporating non-oil business will boost profit margin. So, why LPG? The marketing margin of both household LPG and auto LPG are higher than the oil industry, and even the LPG demand gradually dropped, PTG surprisingly expanded the gas shop to reap a benefit to be a dominant player in the LPG industry. After entering this industry, the sales volume keep rising and the market share keep increasing to 11% in 2020. The 5-year revenue growth rises with a CAGR of 34%. What about other non-oil business? Convenience stores, food and beverages are the highest gross profit margin business, about 33% of the revenue. The aggressive store expansion of Pantai and the convenience stores Maxmart leads to the 5-year revenue growth of 25%. Therefore, the expansion of the non-oil business leads to the overall gross profit margin expansion. And along with the reduction in selling and administrative expense from cost-cutting policy, it will boost the EBIT margin and net profit margin further.
Given its solid fundamental, PTG has high potential to capture growth. Start with a key profit driver for oil retail. Marketing margin remain high at 2 baht per liter, and the government will not intervene as diesel is still below the cap price. So, PTG, the second largest oil retailer, will gain more gross profit. Second, CPO price increase along with the new government mandate that set B10 as a new pliable diesel. With a higher price and growing demand, we observe an improvement in profit from holding a 40% stake in PPP Green Complex. Apart from the short-term growth, we also foresee the long-term growth. First, provincial areas in the north and northeastern expand higher than the overall Thailand growth, despite a rising demand, but but supply is limited, as independent or retail is still large. So, PTG, that dominate in these two regions, can expand more to meet the higher demand. Second, for car retail, or the grocery in the service station, become a new growing retail channel. However, market penetration is still low. So, the abundance of PT service station will become a platform for MaxMart and Pantai to expand. And third, biodiesel consumption and production increase, followed by the government plan. This will benefit PTG as it targets the diesel user. Also, PPP Green Complex is competitive because of large capacity. To sum up, PTG has the potential to capture both short-term and long-term growth.
By taking into account a positive outlook in oil business, the ability to capture non-oil growth, and a cocoa station non-oil store expansion, we expect a revenue growth of 6.7% CAGR and a bottom line growth of 16.6% CAGR, driven by increasing biodiesel share profit as well as improving operational efficiency, as the net profit margin will expand by at least 90 basis points. The store expansion and profitability are well supported by a healthy balance sheet. From PTG business fundamental, we expect a growing free cash flow based on its low level of capital intensiveness and a strong negative cash cycle. And we expect to see a potential deleverage, which will provide a future financial flexibility on debt financing. Despite low leverage, ROE will be primarily driven by improving operating performance, and we believe that PTG will going to maintain ROE over all peers. Given the uncertainty of oil price fluctuations, we derive a price-to-earning base target price of 20.6 baht from a P multiple of 17.3 times, based on a -1 standard deviation of 5-year PE band, as we forecast that the economy and oil demand are yet to recover. Furthermore, our valuation also in line with the forward multiple valuation of local and regional peers that we select based on a similar business landscape that operate in midstream and downstream located in Asia Pacific. From our football field valuation, all other methodologies that we have conducted still confirm a buy recommendation. And for a more comprehensive valuation, we conduct a sensitivity analysis, and most of the cases support our investment strategy.
We have identified 3 key risks that PTG is exposed to. First, oil production restriction may be prolonged and lead to an increase in oil price, which can lower the marketing margin of PTG. Second, if oil price rapidly increase, the government may intervene by adjusting the ceiling of marketing margin. However, we estimate that PTG will be able to charge at least the margin of 1.65 baht per liter, where the company still deserves a buy recommendation. And third, the risk of COVID-19 is applied to a worst scenario analysis, where we assume that the pandemic will persist until the end of this year, which may result in lower than estimated revenue of PTG. However, the company will still yield a 9% upside, even in its worst scenario. We also incorporate ESG analysis into our consideration. The company has many policies to relieve energy consumption, result in decreasing energy expenses per employees. PTG also emphasized on social aspects by values the relationship between the company itself, the customer, and the community. And lastly, its board of directors are experienced and abide with the regulations set by the SEC. Comparing to its peers, PTG has the best governance score and ranked second for overall ESG score among the domestic peers, with third consecutive year listed in THSI and fourth ranking among the regional peers.
With prominent fundamental, thriving margin expansion, growth opportunities to capture an exceptional ESG score, our valuation also shows 30% upside where the downside is limited. Ladies and gentlemen, we can reaffirm that PTG
1
deserves a
minute
buy
left.
recommendation, and it's time to let PTG be the growth engine to your portfolio. Thank you for your attention, and the floor is open for the question.
You can begin the Q&A session.
Can you go back to the share price chart? So first of all, good presentation. Thank you for that. And to me, in some ways, this share price just looks flat. The only place that it really looks exciting is that that red line. So right now, according to that, it's not that exciting. What do you see are the catalysts that will cause this upside to be realized? Like, what is it that the market doesn't see as clearly as you see now after doing a lot of research on this company?
To answer that question, the market regard PTG as a laggard stock, which its price doesn't adjust as fast as other stock. And PTG is a small to medium capitalization company in the energy sector. So we think that the market may underestimate its performance. We have thoroughly analyzed their stock in terms of qualitative and quantitative aspects. And we see that, as you can see from the earning per share, our forecasted earning per share in 2021 is at 1.19 baht, which is bullish than other consensus. So the implication is that we believe in its resiliency and ability to recover fastly.
Can you just try to focus on like kind of one thing that you see? Because right here we can see that most of the market's not seeing what you see. And I'm telling you, you did a more complete research report than all of those. So tell me, what's that like one thing that we should focus on that you see that they don't see?
We believe in its resiliency and ability to recover from current situation. So what we can see is that under the stormy sky, PTG is one of the rising star.
For your ESG slide, can you identify the most material E factor and why?
Thank you for the question. For the environmental part, we believe that the energy efficiency of the company is one of the best compared to its peer. Second, the waste and hazard material management of the company. The company also manage the waste efficiency very well. Third, the company consider well about the health and safety of the employee, since the accident case in 2019 is 0. And fourth, the company strongly value the community relation. It had many policy and activity.
Stick to the environmental. Just stick to environmental.
Okay.
Just one factor, please.
For the energy efficiency, we believe that the company managed energy efficiency very well. Even the industry of the company is considered as a hazard to the environment. PTG has many policies to reduce the environmental impacts. For example, PTG has reduced the energy consumption by installing the solar cell panel in the service station. Moreover, the PTG also has a renewable energy business with their own waste power plant.
Actually, I have a question also related on the environmental issue as well. So if you look at the PTG business, right, you can see that majority of that business rely on the diesels, right? And if you see what happened in European Union right now, diesel is one of the most polluting fuel sources. So, I mean, going forward, you're selling what is against the trend in the world. So, is this how do you address this risk?
So we see this as an emerging trend as well, and we consider this to the company as a risk. So we think that the green energy trend is coming both around the world, and another trend is that the EV trend as well, that many countries try to adopt. But the EV trend in Thailand is depending on the government policy and also the readiness of the infrastructure in Thailand. And we also consider this as our analysis, and we will break down this into short-term and long-term impact. For short-term, if you look at the statistic, you will see that of the total EV car in Thailand, just only 2% is commercial vehicle, while more than 90% is a passenger car. And if you look at the main target group of the PTG mainly target the commercial vehicle. So we think that in the short term, this trend will not pose a significant impact on the PTG. And also, We think that in long term, PTG can adapt well with this trend since the PTG start to implement the EV charging station, and we think that in the long term, it can expand more because of high financial flexibility, in which my colleague will elaborate more on this point.
So in terms of the debt capacity that the company can increase it into 1.5 times as it targets. So from this, the company will get about 10 billion baht from increasing debt capacity. And from our research and compare with the peers' budget allocation for EV project, which costs about 10 to 13 billion baht, this will be enough to implement the EV plan for the company in the future.
So I'll do the next questions. So if you compare, it's inevitable that you have to compare PTG with the PTTOR, right? The newly listed company. So if you look at the non-oil business, right, PTTOR basically act as a landlord. They don't do their own convenience stores. They don't do their own non-oil business except coffee. Right? They collect the rent. Right? They rent out the space. But PTG did the opposite. Right? They do everything by themselves. Right? So why do you think they choose that route? And which model is better?
From my opinion, the company own and operate is the key success strategy of PTG, since its benefits is that the company can maintain control as well as improve its service quality as well as the operational efficiency. Moreover, PTG can reap all the benefit without sharing with partners.
But this, I mean, just looking at this chart right here, why waste the time? Why waste all that time managing people and inventory of all these items and stuff? Why not just become a landlord and lease out the space and focus on the core operation? Just explain why they're doing that, besides just that, it's what they're doing. But from a financial perspective, from an analysis perspective, why?
In terms of business fundamental, since its target customer is farm vehicle, commercial vehicle, as well as pickups, they implement the strategy and set a price in both oil and non-oil to suit its customer, as well as the location is suitable for going to fuel their tank as well as grab some coffee.
Yeah, but what you're talking about is the fact that they want to have services around, which I agree with. But the question I'm asking is, why do they have to manage that? It's just a huge headache.
So as my colleague has mentioned, if you expand through the company-owned, company-operate, you will gain the full profitability, while the dealer-owned, dealer-operate, you have to share the profit. And we think that with the upcoming trend of the forecourt retail or the grocery in the service station, it outperformed the retail industry in Thailand. So if PTG can expand the MaxMart, the convenience store, and also the Pantai coffee shop, it can gain more revenue from that.
So let's go back to that chart we were just looking at. Is what you're saying that if we look at the revenue share of that part of the business, it's small, but are you saying that part of the business is highly profitable and therefore the profit contribution is much higher than the revenue contribution, or that it will be?
It is going to be.
So I guess the real question here is that, there's a lot of CVS operator in Thailand. You have Family Mart, not just 7-Eleven, right? So why do you think PTG, as an oil retailer, can operate convenience stores more efficiently than those professional guys? Did based on the track record, did they generate better returns from running their own MaxMart compared to those guys?
So if you look at the past performance of the PTG, the revenue from the non-oil business in the CVS and also the coffee shop, it grew at a double-digit rate at 25% CAGR. And we think that even though the PTG operates by its own, it can maintain this growth because PTG has its own service station, and also the target group of the PTG is a commercial vehicle. So we think that this will benefit PTG as this user will come and use the non-oil business services.
Time is up for Q&A sessions.
Thank you.
So please say so the judge can give you the feedback for 5 minutes. Yeah, instant feed. Yeah.
Good job. And the questions that we just asked are going to be asked of all the teams, so don't feel like that was directly at you. I think that your presentation was good. I think there's only one thing that I think about. Sometimes it's hard to follow when you have so many charts. As a judge, I'm trying to figure out what your meaning is, and I suspect this will be the same feedback for all the teams, because I think that this is an area that you want to put a lot in there. But sometimes you actually present a slide where the judge misses the message because we get lost. So I just would say that that's one thing. And then the other thing, I think you could feel something in the Q&A, like where if a judge has to stop you in the Q&A, it means you may be going off track. Sometimes if you're off track and you don't have a great answer, it's okay to just stop where you are. So, those are some feedback. But overall, it was an excellent presentation.
Just more on the slides that assuming if the judges are not too familiar with the company and putting a lot of details and changes, and while at the same time listening to what you're saying, it's a lot of things to digest immediately, unless if we know the company well, which in the case at the regional or global level is less so, the level of detail. Yeah.
I have a comment on the Q&A. So obviously the presentation was very smooth. You guys are very well drilled, maybe too well drilled, because for every questions you have like a set of answer, and it's almost like a multiple choice. If I ask this, you're gonna pull that up. You're gonna talk like this is a set of answer that I prepare. I suggest you pay more attention to the question itself. What are we actually asking, rather than figuring it out in your head. So, okay, this is this topic. We gotta answer it like this. That there's a lot of answer that Andrew mentioned earlier. That a bit off track from what we are actually want to hear, want to ask.
Very good presentation,นะครับ. But you lack of hook up the word. I mean, at the end of the presentation, I feel like there is no one hook that make the investor or the judge impressive with your presentation. But overall, it's a good presentation, and I love the way you show the ESG the data. It's very comprehensive and knowledgeable. Thank you.
And I would just add one other thing. Remember, whenever you're in a competition, you want to think of the judge as your friend, not your opponent. And that means when a judge asks a question, what you may want to do is even walk up closer to that specific judge and make an even clearer connection with that judge, rather than feeling, nervous.
Okay, if it's that it for your feedback, we have 2 minutes left, but if you have nothing, so thank you, Team A, for the presentation. You can stay in this room to watch another team.
Thank you very much.
Hello, 1 2 3 โอเคก็ไม่ติด
ยัง
Team B, you can start whenever you're ready. We'll start the time when you begin presenting.
Imagine going on a road trip and you're running out of gas. You need to fill your gas and see a green sign. This is PTG, a secondary road companion. We're Team B. Good morning, distinguished audience. PTG operates in the oil retail business, serving 7 oil products to mainly diesel-based vehicles on secondary roads, while expanding into other 6 non-oil businesses. Being the largest number of stations, PTG has integrated 3 growth strategies beginning from its horizontal integration to backward integration, while supporting imagined growth by diversification to non-oil businesses. Using the weighted DCF with EV EBITDA, we provide a buy recommendation with the target price of 22.5 baht with 16% upside. And why should you buy PTG? With the power to drive the current price.
The first key growth driver is the post-pandemic opportunities. PTG's businesses are affected by several economic indicators. These indicators will grow in the future, and here's why. The world economy will recover from the distribution of COVID-19 vaccines. Moreover, OPEC has an agreement to reduce the amount of crude oil produced per day. As a result, the crude oil price will increase, and so does the marketing margin of fuel stations. How about Thailand? We will experience a jump in GDP from the government stimulus and gradual increase in tourism rate, as well as the boom in e-commerce leading to a growing logistics business and increase in oil demand. From economic recovery, biodiesel demand will increase from the growing numbers of diesel-based vehicles and the mandate from government to use B10 with a potential increase following Malaysia and Indonesia. The government also encourages truck drivers to use B20. Lastly, the non-alcoholic beverages consumption is expected to increase steadily, especially coffee consumption, which still has high potential growth, leading to an opportunity for coffee shop businesses.
The second key growth driver is ongoing competitive advantages. PTG focus on cocoa stations, while peers focus on dodo, resulting in a high agility to respond to customers' needs. For example, PT Max service can help deliver emergency oil and offer 24-hour repair service. And thanks to the cocoa base that help reduce the cost, create a lower fixed cost per liter, result in a cost competitive advantage. While competitors expand the station in the city, PTG expand the station from 4-digit to single-digit roads, focusing on agricultural vehicles and trucks, and expecting to have more than 3,000 stations as PG choose to reach the aging contract and unprofitable station, require less cost and take less time. PTG also owns the most distributed 10 tank farm across Thailand. And to become the part of customers' life, this is PT Max card with 15 million users and a growth of 2.5 million users per year, giving the best deal for diesel-based customer at 1 point per 1 liter, which is the highest among competitors. PTG also stands above water in biodiesel industry and is produced the purest B100 and the location in Prachuap Khiri Khan, stay among suppliers and get benefit from two-way tender. Our analysis confirmed with the team's customer survey, adjust the survey result with the SWOT analysis. We ensure that PTG's market share will continually move up in the future. What about company's growth plan? PTG aims to expand the station in the city, vicinity, and along the highway with its non-oil businesses.
The third key growth driver is wealthy financial performance, starting with profitability. The rising revenue projection is driven by horizontal expansion, both cocoa and dodo-based station expansion, and higher sales volume per station from higher customer awareness, and also expansion of non-oil businesses. All these drivers will be supported by PT Max card. And for higher EBITDA, is driven by light asset strategy and lean business model, which lower the fixed cost per liter, creating economies of scale. The net profit of the company is high by cost competitiveness, business agility, and non-oil businesses margins. Not only that, but PT will also receive 4% net profit sharing from biodiesel business, supported by positive elements. ROICs of the company are higher than WACCs, indicating that the company has sound growth strategy. For increase in efficiency, we forecast PTG to have the best efficiency among peers in terms of using assets to generate sales, thanks to economies of scale. Lastly, leverage. PTG plans to lower debt equity to be at industry average, contributing to stronger balance sheet. Moreover, its cash from operation will be enough to support a significant payment. And lastly, it will continue having high liquidity from negative cash conversion cycles. After we know PTG is a good company, is this a good investment?
We consider PTG as a good investment, supported by averaging 50-50 of the consolidated EV/EBITDA multiple with the sum of the part DCF to get the target price. Let's start with the sum of the part DCF. We calculated the price per share from 6 businesses and broke down the revenue into each segment where we forecast each oil product separately. For example, Gasohol 91, we calculated each component of the price structure by running a regression on the ex-refinery price and the marketing margin. And we also run a regression on the market volume sales to multiply with the market share based on the team survey and the SWOT analysis to get the company's volume sales. The new station sales is also driven by the store expansion based on the management guidance. And we also double-check the plausibility by using the Google map to navigate the substantial leasable stations and to minimize the cannibalization effect. Moreover, other corresponding elements are forecasted to be in line with the sales. Bottom-up betas were calculated based on their peer groups, resulting in different discount rates, and the terminal growth rate of all businesses are assumed to move towards Thailand's long-term inflation. And we arrived with the DCF value of 20.6 baht. And to support our DCF, our sensitivity analysis shows that even the change in the terminal growth rate and the discount rate, there's still a cushion to change the recommendation. Another 50%, we used the consolidated EV/EBITDA multiple to get the relative price of 24.2 baht. The statistical relative is done to mitigate a lack of direct peers, and it shows a higher multiple than the current EV/EBITDA, ensuring that the stock is highly underpriced. Moreover, the stock is currently traded at all multiple levels being lower than the historical average, a strong signal suggesting a buy. After weighing both valuation, we got the target price at 22.5 baht, with the 1-year total stock return of 26.8%. Moreover, the maximum drawdown during the COVID-19 lockdown has been recovered faster than peers due to PTG's defensive target customers, the dispersed stations, and a recovery in oil price. But would PTG be able to manage their risk?
Amid the good stories, we assess the risks using stress tests and highlight on 4 factors. Firstly, PTG faces the fluctuation in fuel demand from the pandemic. However, the demand has to fall below 15.2% to change the recommendation. Secondly, the government interventions impacts commodity prices, but there's still a lot of cushion to change the recommendation. The third factor is the marketing margin volatility to global crude oil price. PTG reduces the impact via inventory management, showing a large gap to change to sell. Another concern is the rising trends of EV cars, yet PTG uses the agile business model, leaving a 31.7% cushion. To complete our analysis, we ran 250,000 times of simulations and still resulted in a 61% upside.
Many traditional ESG activities have been implemented to conserve the natural world and also consider the social relationship. For example, the palm complex produce biodiesel using European standard with lower greenhouse gases emissions, as well as Thai, which is an online market platform for local people, and it has helped to develop the marketing strategy while still at the beta stage. Moreover, 5-star CG score from IOD and team estimation using CFA criteria show a high standard for running the company. As a consequence, PTG can lower WACC by 6% based on the past study result. Those great performance have been confirmed by THSI Award for 3 consecutive years.
With PTG's strong fundamental, we issue a buy recommendation with a target price of 22.5 baht. Ladies and gentlemen, in the midst of the crisis lies great opportunity. Thank you. The floor is now open for the Q&A session.
All right, excellent presentation. Let me start off with If I looked at your revenue, long-term revenue assumption, it was 6%. If I looked at your long-term EBITDA assumption, it was about 6%, which tells me that the margin is not widening. It's going to stay flat. So that tells me that the margin may be at a peak. So the second, combining that with your EBITDA multiple, you're showing that your target multiple is almost double what the market multiple is. It seems to be a contradiction. Can you try to explain that? Thank you.
First of all, the EBITDA margin is rising compared to the revenue, although we use the number 6%. However, in terms of decimal, it's increasingly, gradually increasing. And these two numbers are different. And in terms of EBITDA.
But you're still talking about a small difference, right? Or are you saying that that's the wrong number, the 6 and 6? You're saying it's 6 point something, correct?
Correct.
Okay, okay. So the multiple, so what I'm saying is that it appears that the multiples, the margin is not really expanding, but you are expanding you are expecting the multiple to expand. And that's part of the foundation of your argument. I just want to understand, why do you think the market is saying it's trading at a lower EV to EBITDA multiple than what you're expecting? Let us understand about it. Again, like all the other teams, you've done more research on this probably than anybody in the market. So just tell us what you're thinking.
The market EV/EBITDA is because it's a reflection of the environment. It's a marketing in the marketing of the stock price. However, with our analysis, we use DCF based on the long-term strategy of the company. Hence, our EBITDA will be higher because we take the long-term growth and also of the FCFF and also the risk of the company into our valuation. Hence, we firm with our buy recommendation and also higher multiples.
Among the ESG factor, which one do you think is the most outstanding for this company, for your opinion?
Thank you for the question. So in terms of ESG, we expect that the corporate governance is the most outstanding, as we can quantify into our model with the CG adjusted WACC. Through this research from ASEAN Journal Management and Innovation, they have stated that how corporate governance can affect the WACC, and it shows that there multiple regression with the negative coefficient. With good corporate governance, it can reduce the WACC, and for PTG, it can reduce by 6.29%.
I'm going to ask about the non-oil because it's part of your forecast, big part of growth, right? Now, the way that PTG operates this non-oil business is different from its main competitors, which is PTTOR. Right? You look at PTTOR, apart from coffee business, they rent the rest of the business. They are a landlord, right? They rent someone else. They collect the rent, and they let someone else operate this business, right? PTG did the opposite, right? They have their own convenience store. They have their own coffees. You know, they're doing everything on their own, right? And why do you think they're doing that? Why do you think they're doing it better than you know, let the professional do it?
Thank you for the question. Because PG expand its service station 80% on secondary roads, so it choose to lease the stations instead of owning the station by itself and use the Cocoa Bay station or company-owned, company-operate to absorb higher marketing margin without sharing with the dealers. This is what's the difference between the OR and the PG. And moreover, with the Cocoa Bay station, it can also control the cost of it.
No, that is not my question. My question is about non-oil, right? So if you look at PTT station right now, they rent it out to 7-Eleven, right? Let's just use convenience stores as an example, right? They rent it out to 7-Eleven. PT run their own MaxMart. Why do you think you can run MaxMart, convenience store business, better than 7-Eleven, Family Mart, Lawson, you know, these guys?
So thank you for the question. So firstly, at the first stage, so since PTG has more of the proportion of cocoa base and Right now, they're focusing on building the brand awareness into the stations. So by bringing up their own brand for the non-oil business like MaxMart and Pantai, PTG are expecting to boost up the sales volume per store, especially when they are planning to move into the city. So by having their own control on their brands, they can have an ease in the management as well as the cost sharing to lower the fixed cost per unit in one stations. And as we can see from the expansion plan, so PTG are planning to expand their non-oil business by focusing on expanding in the main road along with the expansion of the oil business in order to increase their sales volume per store.
For example, with that, the company can control the personnel cost. For example, it can allocate one personnel to another service station because it's operated by its own by PTG. Hence, the personnel cost in 2030 will be decreased compared to 2020.
In your forecast, you use a lot of regressions to several slides. My question is, why are you using regression in your forecast, along with management guidance, I think you mentioned? Why is that the most appropriate?
Thank you for the question. Since we perceive that since we use the historical data of the regression to run to find the coefficient of the relationship between factors, so we use that to forecast our forecasted year. However, since the regression is based on the historical data, so we also use the regression to compare it with the management guidance as well as the study, professional study research to see the appropriateness. And for some of the factors, we also double check it with the qualitative part, like the market share of the company.
So let's go back to the question about the non-oil business. I just saw the chart you just showed that showed an average growth of 4% in the revenue of the non-oil, or of the MaxMart, I think it was, that you just showed right there. So sorry, 5%. So that's even less than the overall growth that you're expecting of 6%. So it tells me that this is a slow growth part of the business. And it goes back to why do it instead of just leasing out the land. Now, if you showed me that that was 15%, then I would think, oh, okay, so there's really something there. So could you just explain a little bit more?
Thank you for the question. Even though the revenue growth from the non-oil business is small, however, with the higher margin compared to the oil business, it will expand the EBITDA margin and also gross profit margin of the company. As a result, as you can see, the proportion contributed by the non-oil business will be higher from the higher margins of the non-oil businesses.
I have questions about the debt. Can you show me the slide on the debt? The DE ratio. So it seems like this is a highly leveraged company. 3.5 times DE ratio. That is by no means low. It's actually quite worrying. Right? So do you perceive this as a serious risk to the expansion plan? And also, can you describe me the impact from the IFRS 16 on this DE ratio?
Thank you for the question. Firstly, in terms of the impact on the operation, this high D ratio is already impacted by the IFRS 16. However, the PG has agreement with the credit rating that D ratio will not be affected to change the credit rating of the company. Hence, the company credit rating will stay at BBB+. And moreover, the company will also be able to lower debt to equity of the company by lowering over debt in each year, which is in line with the past behavior of the company. And moreover, it will issue the smaller amounts of the debt in each year.
So out of the 3.5 times DE ratio, if you exclude the impact from IFRS 16, what would be the DE ratio?
As of 2019, it will be 3.8. And after the impact of TFI 16, it will be 4.17.
Time is up for the Q&A session. Team B, please stay so that the judge can give you feedback.
So I guess I'll start. Right. I think it's a good presentation, quite catchy, easy to understand, not too many details. A bit on the Q&A. I think almost every team will have the same comment as well. So you guys are well drilled. I think it's part of the game plan because you have to finish everything in 10 minutes, right? But again, this feels like it's too well drilled. Right? When I ask questions, right, the first instinct that you guys go to is like, oh, I'm gonna find this slide in my appendix because I prepared this set of questions. If I get asked this topic, I'm gonna show this, and this is what I remember when I practice the way, you know, this is supposed to be the way I answer it, right? But again, right, you know, please pay more attention to the questions of the judges, right? What is he? What are we looking to see? I mean, what are we trying to ask? Right? That is very important.
Thank you for the presentation and very good comprehensive presentation. And I love your team energy. It's very good. And again, same as Kun Jeep said, when you answer the question, please, improvise the answer, not give us the set of the answer. Okay.
All right, and a couple of things. Just look at where you're standing on the stage. You cannot get further away from the judges, right? Or else you'd fall off the back. But when you do Q&A, you should be trying to engage the judges. Don't be afraid to come forward. Why don't you come forward right now? Just come on, come closer, closer, closer. Yeah. So you want to try to engage the judges when they're asking. We're trying to get our questions answered. Also, I think you've got to avoid saying the word will. Remember, in CFA ethics, we also talk about separating fact from opinion. And ultimately, it's someone's opinion, even if it's an authority, like, you know, the World Bank or something like that, that it's just that, you know, they are expecting that the economy is going to recover, not that it will. So be careful with that. I like the way you showed the Max card, and, you know, that's fun. You know, judges want to have fun, right? We want to have fun in a presentation. And I thought your risk discussion was very, very good. So those would be some of my feedback.
Generally, the level of detail in some slides, I think, are good. Some are a bit too detailed. I think slide CD1, is it? That I can't even see from here. The revenue forecast, yeah. That one. That is challenging to read, to see. It overwhelms, but yeah, just, it's impressive, yeah. But just balancing the message and with what you want to show on the slide.
Actually, on the Q&A, I think I noticed one thing that is very positive. So you stop your friends. That is good because your friends is not answering the question at all. So you actually listen to the answer of your friends, and this is a team performance, right? You guys win together. So if it's important to listen to what your friends are answering as well. And if it's not the right answer, you know, it's the right thing to do. Don't you know, grain jai or something like that, you know.
And one other thing is, one of the risks you have faced when you value a company that has a high amount of debt is that the debt as a percent of total capital is very high. And many people make the mistake of carrying that high debt level all the way to the future. And as a result, their weighted average cost of capital is very low. And that was going to be my last question, but you got saved by the bell. So that's just a risk area. If you win and you go on, you better be ready to answer that type of question about the WACC and the cost of capital.
Okay. Thank you, judges, for your feedback, and thank you, Team B, for the presentations. Now let's have some 15 minutes coffee break and we come back here again at 10:20. And Team B, you can stay after the break for watching other presentations.
เราต้องถ่ายกันเราต้องแข่งกันแล้วพี่เจนจีชอบน้องทีมแรกมากเลยเวลาดูแบบไม่เราว่าเราชอบความเป็นทีมสองทีมแรกจะมีความแต่ฉันเห็นเลยนางมาขอมันมีมันแต่ฉันน่ะชอบเด็กแบบนั้นฉันชอบเด็กแบบฉันชอบไม่ฉันชอบเด็กที่ดูไม่สัตคือดีคนละแบบแต่ถ้าเกิดว่าถามว่าคนไหนหน้าเทรนอะหน้าแรกกลัวไปหมดแต่เป็นเด็กดีมาเขาแอคเป็นเด็กแบบมีแบบกลุ่มแรกแล้วโดนจับกลุ่มแรกเลยเข้าน้ำแบบพี่เกินทำไม่เข้าเลยเหรอ
test, test.
Test ค่ะ test test test
Test,
test
test,
test
test,
test
test, 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 test,
Hello,
test,
hello.
test, 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 test.
test test test
test test test test ค่ะ test 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 test
test test
Hello, test test.
Okay, Team C, can you stand on the. Can you get ready? Team C, you can start whenever you're ready, and we'll start the time when you begin presenting.
Good morning, ladies and gentlemen. In the past, PTG raised from being at the edge of bankruptcy during Asian crisis to second leading position in oil retailing industries. And today, we are inviting you to feel the upside and get on the highway of prosperity by placing a buy with a target price of 21.04 Thai baht, indicating a 22.3% upside. We support our recommendation by 4 reasons. Feel favorable oil volume growth from station expansion and volume per station, uplifted marketing margin with stable outlook, enhanced competitiveness from non-oil and joint venture business, a legitimate investment confirmed by our valuation. But before diving into detail, let's see PTG at a glance. PTG ranked second in Thai oil retailing under PT brand and further strengthened ecosystem through non-oil ventures and biodiesel upstream joint venture. Is mainly operate through company-owned, company-operated station with 12.6 million SMAC member, ensuring full controls and in-station traffic. The majority of station is in provincial area, as it aims to target Thai rural. This translates into decel to total volume sold of 72%. Looking into oil retailing industry, see that the market is highly concentrated, as 23% of stations generate 84% of total volume sold. This is while PTG, the fastest growing player, has thrived against the Thai for the past 5 years, shown by 1.4 and 1.8 times surge in its market share by volume and station, respectively. The success was achieved through small town expansion, station conversion, and better brand recognition. So, ladies and gentlemen, PTG's strong fundamental and past success are only small part. Why we call it a buy? The bigger parts lies in the future.
So let's start with our first reason, where we believe that PTG oil volume growth will continue to be favorable. PTG is expanding into more robust demand areas like Bangkok and Eastern region, where oil consumption, growth, and volume per station are more favorable. We see that this move is highly feasible as station concentration in key region is still low, and PTG yearly expansion plan requires only 1% of the non-branded station to be converted. Also, PTG could expand twice as much with the same amount of capex while having faster time to market and additional depth room for expansion. Looking deeper, while other players are competing in the main road, PTG aims to be nearer to the customer and beat the market by tapping into residential area with super small format and competing in the sub-road with more amenities through MaxCamp. We believe that this is the winning strategy enabled by its cohort focus model, which allows for localizations and 2 times higher cashback per liter through PT MaxGuard. With this, PTG footprint will reach 2.4 thousand stations by 2025, and as they have better brand recognition, PTG SSSG will beat the industry by 1.3% with an oil volume CAGR of over 6%. And to top off the promising volume growth, PTG marketing margin will also be stable at a high normal level. With a big change in marketing margin affecting PTG EPS by 3%, we analyze that the currently high marketing margin is here to stay for 2 factors. First, stabilizing crude oil price from OPEC's monthly meeting from the norm of twice a year to adjust to production level. Second, Thai baht, a factor 7 times more sensitive to marketing margin, is strengthening from attractive real policy rate and Thailand account surplus from the recovery of export and tourism sector. With this, our regression analysis also confirmed a marketing margin range of 1.8 to 2.2 Thai baht per liter, signifying a high normal level compared to pre-2017. So with all of this, we expect PTG to be the main beneficiary as they don't need to share marketing margin with the dealers from its cohort focus model.
Not only oil side that look promising, but also non-oil and joint venture business. We see that leading players enhance in-station traffic by adding cafe in the station. This is an opportunity for PTG since the market is growing and currently Pantai covers only 12% of total PTG station. Moreover, Pantai could leverage on 12.6 million members of PT Max Card to compete in the market. As a result, we expect Pantai to break even in the next 3 years, which will help PTG to become more resilient to marketing margin fluctuation. Second, synergy between biodiesel refinery and PTG will be realized. This is ensured by a secure distribution channel from PTG and support from government to encourage biodiesel usage. We analyze that with excessive demand from PTG, PPP will run at full capacity throughout the next 5 years, despite the capacity expansion. And in return, PTG will enjoy an implicit cost saving of 0.83 Thai baht per liter by having PPP in hand. As a result, PTG will cover with traffic creation, better brand recognition, and synergy from PPP, together with a more stable ROE at around 20% and improving net profit margin up to 2.1% by 2025 forecast this year. And lastly, PTG is a legitimate investment confirmed by our valuation. PTG stock price dropped by 50% and now is still below the pre-COVID level, while net profit is expected to be at all-time high as a result of resilient demand, station expansion, and effective cost control. However, PTG is now traded around -1 SD in both PE and EV/EBITDA band, which is only 16 and 18% of the time in the past 5 years. So ladies and gentlemen, a rare discount has now returned.
Our sum of the part valuation suggests a target price of 21.04 Thai baht, incorporating different financial performance and risk profile. We break it out into 3 units of core, food and beverage, and biodiesel refinery. We use 2-stage SFF model to all units, SFF&B, where we use 3-stage to allow Pantai to reach a mature phase by 2030. First, core units of 18 baht is mainly driven by 3 main drivers: an oil volume growth of 6.7% CAGR due to growing volume per station and station expansions, a stable marketing margins of around 1.9 baht, and non-oil sales growth of 19.7% CAGR, mainly driven by expansions in LPG and other bags. Second, F&B of 1 baht is mainly driven by 19.6% CAGR from Pantai sales over the forecasted period, due to the store expansions and growing sales per store up to 3.2 million baht by 2030. Lastly, a 40% ownership in PPP gives a value of 1.8 baht to our target price, with an expected profit of over 1 billion baht in the future. This is driven by the full utilization rate, double capacity, and favorable margins at 3.8 baht per liter. To confirm our valuations, we benchmark its PE and PEG ratio with its peers. Both indicates that PTG is undervalued and it is just the right time to buy.
And now that we have filled our tank with our rationale filled, let's do a final check on risk and ESG analysis before getting on that highway of prosperity. We conduct a risk prioritization where we see that the emergence of EV and marketing margins fluctuation are the 2 key risks towards our investment. Starting off with EV risk, we deplete PTG oil cash flow to 0 to see the impact on our target price, given that the company didn't do anything. An extreme case with aggressive adoption would incur a downside of 4.9 baht, resulting in a whole recommendation. However, this is highly unlikely, as PTG already has planned to install EV charger, and the government support only extends to EEP case, a scenario with a downside of 2.1 baht. Still, a buy recommendation. Next, our Monte Carlo model, based on marketing margin with 10,000 observation and 5 wax scenario, suggests a 67% buy probability. And even if PTG marketing margin were to fall into its 5-year worst of 1.8 Thai baht per liter from this year onwards, it would still result in a hole. However, we don't think that this is the case, as given the current Thai baht strength, the Brent oil price will need to be in the pre-shale oil boom period, which hasn't happened for the past 7 years. Our analysis also extends to E, S, and G, where PTG earned a B+ rating from Refinitiv. Environmentally, the company has been a supporter of using clean energy by implementing biodiesel use in logistics and solar rooftop installation. Socially, PTG emphasized on both society and workforce development with total training hours provided of 100,000 hours. And finally, for governance, where PTG earned an excellent rating from Thai IOD, highlighting a transparent and rewarded management. With this, PTG will not only be a growing company, but will be a company with sustainability. And even with ESG affecting investor risk appetite and company future performance, our sensitivity model still suggests a buy in most of the scenario. So ladies and gentlemen, today we place a buy recommendation on PTG under our rationale of few. Thus, before this stock set apart on a highway departure, we would like to invite you to take the ride and let's feel the upside together. Thank you.
Now it's time for Q&A session.
Good job. Can I ask you about your valuation? Can you show a slide of your valuation? And in particular, I'm looking at your weighted average cost of capital, which is a pretty high number. Let's say we've seen some other numbers today, but your number is about roughly 10%. Please explain that and help us understand how you've come up with the variables for this.
Okay. Okay. So to clarify that, we used a 5-year weekly beta of PTG instead of the peers of medians of peers. So the reason is that we believe that given a unique characteristic of PTG and unique expansion model, which is quite unknown in terms of in oil retail industry, so the beta should be higher, and that's given rack that higher to compare to other people.
I have a question about your Thai baht view and crude oil, what makes your assumption or view more accurate than the market?
So we have done a regression analysis with the R square of over nearly 70%. In this case, our Thai baht, to be able to derive that marketing margin, we are assuming a constant Thai baht of around 30 Thai baht per USD. And we take into account the fact that crude oil price is going to go up, and still our recommendation will still be valid at a buy.
Sorry, I mean, why do you think you're more accurate than what the market is seeing?
If I'm getting that correctly in terms of Thai baht only. To break down this question, the Thai baht would affect marketing margin, which in turn could affect our valuation a lot. In this case, we have sensitized the Thai baht given the current crude oil price, and to change our big picture recommendation, Thai baht would need to be at nearly 34 Thai baht per US dollar, which is again very highly unlikely because this case last happened 4 years ago. Thank you.
Touch a bit on the ESG. What made them deserve the high score of the CG rating?
So the higher score from corporate governance actually come from the fact that PTG as a company has a full transparency disclosure, as well as if we look into their board of director, we can see that 60% of the board of director has been with the company for a long time. And also regarding the trading activity wise, we looked into it in the past and didn't see any abnormal trading activity.
Okay, thank you.
I actually have two questions. The first one is about the oil retail business. So you mentioned that going forward, they're going to expand. Well, they start out in provincial area. Now they're going to expand into Bangkok and vicinity, eastern area, eastern provincial area. These are rich, relatively richer area, higher GDP per capita. And there's a lot of competitors. Right? Well established, they've been here way before you. Why do you think you can outcompete this guy? That's the first question.
So to answer your first concern, with PTG strategy of placing their station nearer to the customer, especially in Bangkok and vicinity, we believe that the traffic creation would be higher, as PTG aims to be the first and last place for the customer to visit. For other region, PTG aims to be at the sub-road, which means that competition could be lower. However, we understand the fact that in oil retailing industry is a more of undifferentiated product. Does price play a key role here? That is why we analyze that PTG, through its PT Max Card membership, can provide 2 times higher cashback per liters. And this is because they have the company-owned, company-operate model, where other players are focusing on franchising, which means that they can provide higher cashback per liters in this case. So we have an analysis on other people membership card as well in this case.
Okay. So when they start out in provincial area, their strategy is to convert the mom and pop oil stations, right? So they don't have, it's not a green field. They don't have to start all over from the scratch, right? But you know, that is not possible in Bangkok, right? You're not having any mom and pop gas station that doesn't exist anymore. So it's going to be a green field. So you have to invest a lot more compared to the provincial oil station. So do you think that would affect your return on invested capital going forward?
Okay, I understand that. But actually, in terms of the station in Bangkok, there's still the non-branded to be converted. And also, I understand you about the CapEx, but we already incorporate the increase in CapEx already. And our valuation is still a buy recommendation at 21.04.
Can you show your free cash flow forecast? What I just noticed on your CapEx chart is that your CapEx is falling in the final years, right? And let's just see here. So also your changes in working capital there are positive when usually it's negative, but I think in this case it is a negative cash conversion cycle, right? Okay. My question is, I'm trying to understand how you get to a target price of 21 roughly with such a high discount rate, whereas prior teams we saw at roughly the same amount but with a much lower. So can you just explain about free cash flow a little bit so that we understand where this strength is coming from?
Okay, so in this case, we expanding PTG footprint around 80 to 100 stations per year, and also we assume the growth rate around 4% throughout the forecast period. And also, in terms of the capex that you're wondering, is that in terms of next 2 years, the expansion will be more selectively expand.
So just to a quick add-on on that, we have analyzed that in the future, PTG will rely more on that oil growth, will rely more on higher sale per station, in which I have done analysis here. Because in the past, they have been expanding aggressively. Thus, their growth comes mainly from station expansion. However, in our model, we are suggesting a station expansion of around 50 to around 100 stations per year with SSG at the same rate for that of the market. So in the future, they will be relying more on sales from higher volume sale per station.
Okay, so in order for us to feel comfortable with your valuation, it's that the EBITDA is going to be rising and the capex is going to be falling, or let's say less than what it was in the past, which gives us a higher free cash flow in the future years. I would say that's a risk in my perspective. But the next question I have is, why is we've asked before to other teams about the idea of leasing the facilities versus operating the convenience and all that, and then you're showing me that Pantai doesn't make profit or break even until 2024. Why are they wasting their time in this business? Why not just lease it out to operators that could be much, much more efficient?
So to clarify that, if PTG doing Pantai as their own, they could give back a cash back to customer 2 times more than other players does. And also, this will attract more customer coming into Pantai Coffee, given that Thai norms of living in free giveaway or a discount. And also, the reason behind the break even is that currently SG&A per store is around 1.2 million. And in order to cover that cost, Pantai should sell around 100 per store per day to cover that cost. And we expect that to be in 2024 as a result of the station expansion and growing Thai norms of buying station coffee.
A question on your valuations. You mentioned PE and EV/EBITDA being one standard deviation below. Where is your view different from the market then, to explain this difference?
Okay, so our view is that PTG is now relatively undervalued. So we have to go through the domestic peers and also international peers. All of them are increasing at around 30%. But currently, PTG is almost the most laggard players in this industry. So our view is different because the net profit is already at all-time high. So this would be a catalyst to PTG stock price to skyrocket this Monday morning as well.
Monday morning, you mean? All right. I have a question about your ROE slide. So there's a big jump in the ROE from 2018, from 11.4% to 23% in 2019. What was the cause of that?
Okay, this is mainly due to we can increase the net profit margin while we can using lower leverage. Yep.
In the year 2022, PVP just expand their capacity by 2 times, thus resulting higher profit margin.
Right.
Time is up for Q&A session. Team C, please stay so the judge can give you the feedback.
Yeah.
Please stay first.
Thank you for a very good presentation. You guys have, good timing management for the presentation, and also the good visualization on your. And other than that, would be like how you present in terms of the valuation. I think it's a bit. A lot of a lot of data on your presentation. Sometimes you may have make it more comprehensive for the user. Thank you.
Thank you.
Good job. I think that the slides were more easy for me to understand. Like here we have just two. I think even that's hard sometimes as a judge. But also I think sometimes you showed just one and then another. So I think that was good. I think your Q&A you did pretty well. You definitely stayed on point. That's the key thing, But I would say also your band charts or showing where the multiples were. I think the challenge for you and all the teams is that you need to explain why the market is wrong. And I think that that's the question that we're trying to get out of you. Because everybody can see that chart shows it's down, but people are going to say, yeah, so what am I going to believe? 1 million people that are buying in the market or you? Well, you've done a lot of work on it, so maybe you. Also on ESG, I think that you have to highlight, I think almost no team really highlighted the downside. It's all, this company's great, ESG is great, they do this, they do that. Well, that's bullshit. We know that. That's just companies, trying to tick all the boxes. But we also have to kind of understand any risks and stuff like that. As far as your presentation, I think it was good. And I liked one thing in particular is that right in the beginning you explained like how or what caused the change. I think that's very important. One thing I do want to say is that when you answered a question, you slipped and you said we, as if you were answering from the company's perspective. Remember, you are the analyst on the outside analyzing the company. So those are some of my comments.
So actually, I think the presentation is good. Slide quality is good. Overall, very smooth. And just one thing, that there's one slide that really raised the questions. And I think if you get to pass into the regional round, you should definitely take it into the appendix part. Don't mention it. That is the historical PE band and EV/EBITDA band. Now you're saying to us that this thing used to trade 35 times. And now it's trading at 20 times, so it's one standard deviation below 5 years mean, right? That is just not going to cut it, right? So you do the peer comparison, that's good. You do the DCF, sum of the part, you forecast all this business on a standalone basis, and then you combine it together. That is all great. Just take that thing out. It's going to raise the questions.
I like your time management. It's exactly 10 minutes for your presentation. On the Q&A, just it could cover a lot of questions we asked, more just answer the question that the judge is asking. I think I could say that for most of the teams as well. That would help you immensely. Listen to the question. There's a reason behind why the judge is asking, and answer that to the judges. Yeah.
Thank you, our judges, for your feedback, and thank you, Team C, for your presentation. You can stay in this room to watch another presentation.
Test.
Team D, please get ready on the stage. Team D, you could start whenever you're ready, and we'll start the time when you begin presenting.
10 years ago, from a small player that no one ever heard of, now PTT is ranked as a second place in an oil retail industry. And today, we are here to show you how PTT become a successful company and still continue to be. Good morning, distinguished audience. We have identified a timely investment opportunity, and we are recommending a buy on PTT. Based on the market price as of February 24, 2021, at 18.4 baht, and our target price at 21.75 baht, there is an 18% upside. Evidently, a strong buy based on three major reasons: the solid backbone foundation in oil retail, the new frontier of growth in LPG and biodiesel, and superior financial performance reflecting the future prospects.
From its root in oil service stations, PTT has been a pure service station player, which differs from its integrated value chain peers. And its move into Pantai, Maxmart, and Autocare has helped them to diversify its business and receive a higher margin. PTT past success attributed to two main strategies. First, light asset strategy, which helped them to expand fast by renovating and leasing out the all independent service stations, which take less time and capital expenditure to expand COCO stations, which are very different from the industry standards. Second, small town strategy focuses its expansion plan in the upcountry and local road first. This not only helped them to not face its competitors directly, but also slowly building awareness and loyalty among the commercial segment and upcountry customers before entering Bangkok. And this has helped PTT to secure its unique position in the market with a commercial segment focus.
Let's move to our first supporting point for a buy recommendation, solid backbone. The two reasons why PTT could maintain its strong performance in the future are: first, oil will still be the major revenue for PTT, and second, transforming to one-stop service station. Oil is still king. There is still a long road ahead for EV adoption in Thailand, especially for commercial segment, which is PTT target customer. The commercial battery electric vehicle will not be available due to the infeasibility of battery range and weight and the lack of mid-route charging station. As a result, we see that oil will still be the major fuel in Thailand for the next 15 years. The oil consumption is driven by the GDP. The rise in GDP then results in an increase in passenger car ownership and a rise in freight transport for commercial segment. This makes the motorization rate to grow by a CAGR of 4.43%. We then forecast that the future proportion for the oil fuel vehicle would be maintained at 91% of total accumulated vehicle. As PTT is well positioned and considered a leading service station in Thailand, it would enjoy the above industry revenue growth of 8% CAGR. Moving on to transforming to one-stop service station, as the PTT COCO service station will continue to increase, we see the potential for Pantai and Maxmart to expand along with the service station. This could create a one-stop service station and attract more customers. With diversified portfolio to non-energy business, PTT could utilize its PT MaxGuard ecosystem from its touchpoints and benefits from generating a higher margin from the margin-accretive non-energy business. As a result, we see the potential for the non-energy revenue to grow by a CAGR of 14%.
Apart from its solid backbone foundation in oil retail, PTT also enjoys the new growth drivers in its new line businesses. And these are the new growth drivers: the LPG retail and biodiesel business. Even though LPG consumption in Thailand indicates a stagnant industry trend, LPG actually provides a higher and more stable marketing margin, and additionally provide leverage synergies to its core business. LPG can be categorized into two sectors: the automotive sector and the household sector. As for the automotive sector, PTT are replicating its successful light asset strategy and also utilizing its own oil retail station to expand the new LPG stores. On the other side, for the LPG household, PTT could outwin other competitors by running a self-operated model, which gives PTT a competitive advantage of lower gas price. Next, the biodiesel, which is purposely used for blending with diesel fuel. The usage of biodiesel in Thailand is forecasted to grow at 10.4% CAGR, benefiting from the government regulation of replacing the B7 gas to B10 as a new standard diesel mixing. And this will result in a greater customer demand and a higher B100 price. PTT could capture this growth trend through the stable revenue of its own biodiesel value chain, the palm oil complex. and not to mention the high barrier to entry of the industry itself that would make PTG a valuable player in the industry.
And lastly, PTG will get a superior financial performance during the forecast period, thanks to the solid revenue from oil business and positive future prospects, which we will look into two parts. First, PTG net profit margin has increased over time and stay over 1.5% in the forecasted period. Since PTG has entered into the margin accretive business, which generate the gross profit margin over 30% compared with the oil business that generate around 7%. Moreover, the EBITDA from non-energy business has increased from 15% to be around 23% in 2026. This confirms that PTG will generate a better net profit margin and able to sustain value to the investor. Second, PTG will have enough cash flow from operating activity to cover its annual capital expenditure, which is around 4 billion baht. Moreover, PTG can increase the level of debt financing since net debt to equity ratio has decreased to be around 0.31 in 2026. As a result, we see that PTG will have a healthy source of funds to support further investment in the new business.
From valuation perspective, it confirmed our strong buy recommendation with the target price of 21.75 baht using discounted cash flow analysis. The target price is derived from 5 main businesses, of which energy business have accounted 59% of the target price in total. For cost of capital, we apply Gordon Growth model to obtain the expected market return of 7.85% and 1.18 adjusted beta according to that model run, which result in 8.01% cost of equity based on capital asset pricing model. Meanwhile, the cost of debt stands at 6.54%, deriving from the credit spread approach. As a result, we come up with a weighted average cost of capital of 6.92%. We maintain the marketing margin of oil business at 1.9 baht per liter and 2.24 baht per liter for the LPG business. Also, we implement the terminal growth rate of 1.5%, which is based on the expected inflation rate of Thailand. This assumption will also align with our conservative view regarding the ESG risks. Comparing to its peer, PTG's ROE is expected to be the highest, while its forward PE is relatively lower than the mean, which suggests it is undervalued, especially when comparing to the later OR, which is more expensive. This is also confirmed by the current trading price of 18.4 baht, which is traded at a lower PE band. Therefore, this is the right time to buy PTG.
We identify 6 market and businesses, and the biggest threat to PTG's valuation is the higher and faster EV adoption than we anticipated. And this scenario might be driven by the increased government support of the EV cars becoming more affordable for customers. And this will affect our oil per station volume growth. However, despite these scenarios, we can see that there is some potential upside to our target price. And this is due to PTG has been reacting and mitigating this trend already, such as investing in EV charging stations or the investment in the non-energy businesses. Regarding to ESG, we are seeing that PTG is stepping to the right direction. And this is because we can see from its initiatives disclosed in its 2019 sustainability report that its initiatives are effective and up to industry standards. However, we see that PTG can still improve in terms of its specific industry KPI disclosures. We can potentially help that attract future flow of funds.
In summary, with the 3 reasons of its solid backbone foundation in oil retail, the new frontier of growth in LPG and biodiesel, and superior financial performance reflecting the future prospect, we have concluded that PTG is indeed a great investment opportunity and best suited with a buy recommendation. Thank you for your attention, and the floor is now open for questions.
All right, excellent presentation. Let me start off by, you mentioned a target debt-to-equity ratio of 0.52 and a weighted average cost of capital of 6.9. What I'm concerned about is that you may be using the debt structure that the company has today to value this company to infinity, when in fact the debt structure may actually be falling, right? So just explain to me how you got this weighted average cost of capital, because if you're wrong and it's not 6.9, it's more like 8 or 9 or something like that, how does that affect the price or the value that you calculate?
So let me clarify your question. So you're wondering how we come up with a different target debt ratio from the weighted average cost of per capital, right?
Yep, right here you have 54% in debt. So you have more debt than equity. No company is going to exist forever like that. So my question is, I'm afraid that your WACC is actually too low. What would happen if we raised that WACC to 8 or 9%? Do you have a sensitivity on that?
First of all, for the target debt ratio of 52%, we look at the historical debt ratio of the company during the five-year historical data, which is the rapid expansion for the PTG, and PTG could still service such level of debt. So we believe that implementing the 52% debt ratio is appropriate because as in our forecasted period, as PTG is diversifying into the non-energy business, which is margin accretive, this would help the PTG EBITDA to be higher.
But if we go ahead 1 year or 2 years, your debt to equity is falling. We value the company again at that time. Your WACC is not going to be 6.9. It's going to be higher because you have less debt, I believe. But yep, go ahead.
With the increase in WACC, it would definitely lower our target price. And we can see, however, it still have a potential upside to an increase in WACC.
It actually is also about your DE ratio. In one of your slides, you show the net DE is actually 1 time something. So that is drastically different from the other teams and also from the financial statement as well. Can you explain it to me? Why is it 1.09 times? Have you incorporate the impact from the IFRS 16 into this?
Actually, we didn't incorporate the IFRS 16, but what we see is that we use the current net debt, which is the interest-bearing debt that PTG has from the debentures and also the financial institution loan.
And let me add on to my colleagues, because we have researched that the implication of TFIS 16 might not have the long-term effect on the evaluation, but in the kind of like short term, as this adoption is quite complicated, it might reflect into the valuation that we calculate. Therefore, we want to minimize those kind of complicated effects in order to avoid this, maybe the miscalculated of the price.
Okay, got it. Actually, I'm just going to follow on another question. It's about the non-oil. Right? So if you compare it to the OR, they use the landlord models, right? They don't do it themselves. They don't do PTT Mart, right? They lease it to 7-Elevens, right? So why do you think PTG with do it DIY models, do it by yourself models, it's going to be more efficient, better than the landlord models?
So first of all, thank you for your question. So the reason that PTG is mainly utilizing the self-operated model because we will receive a higher margin based on that. And the second thing is that our objective for PT MaxMat is not to attract more customers to enter to PTG, but instead to serve the current customer that PTG is having, which is the commercial segment. That's why it's better for us to have a higher margin, but still be able to maintain and satisfy our current target group.
You have an oil CAGR of 8%, and I think you're increasing market share, which implies that you're taking market share from other players, given that it's concentrated. What is it about the company again, which is making it able to do this?
Okay, so first of all, since PTG is expanding in terms of the independence by acquiring the independent service stations, it is able to capture a lot of the independent retail market share, which is still available in the market right now. So could you go to slide of the total number of oil service stations in Thailand? So as you can see, the independent players in Thailand, there's around 20,000 of the overall market. That means PTT can still utilize this light asset strategy to really expand faster than its competitors who usually expand by the dealer's own dealer-operated model.
Can you go back to your first slide, the first slide? You have 3 points that you highlighted in this whole story. And this new frontier of growth, I'm a little bit nervous that this is not that critical. How significant is LPG and biodiesel to the overall value? Let's say your target price is 21.75. What what percent or what amount of that price is coming from that area?
For the LPG business, it's accounted around the 3 baht, and for the biodiesel, we incorporate it into the oil and other, which is around 3 baht as well for the biodiesel from the PPP Green Complex.
So you feel it is this significant element?
Yes.
Okay.
Yeah, stick with this page first. In my view, you're quite bullish on the Pantai business, given that you value 4 baht for the company. Can you elaborate on this valuation?
So we apply the SSG of Pantai to be 1.4% to align with our conservative view. And with only 1.42% SSG, the top line revenue growth of Pantai is actually high at 14% CAGR.
That ability is achieved by having still a lower number of Pantais within the in the PTG service stations. We have a lot of room to expand, even in PTG service station, as we are now reaching the number 2 and number 1 of Thailand. Therefore, we see that the most of the growth driven will be by the store expansion plan.
How aggressive of the store expansion?
Could you go to the
The store expansion is, we forecasted around 50 stores per year within the service station, and we see it is a necessity for becoming the one-stop service station.
15?
50.
Oh, 50, all right.
Can you go to slide 25? So the EV impact to the sales per stations, right? I noticed one thing. Maybe it's just, I don't fully understand that. Yeah, this one, that table on the bottom left. So impact on the current rate, EV utilization rate highest minus 100%. Your target price is still 16 baht. What does that mean? You mean if everyone is using EV, nobody is using diesel and gasoline anymore, the target price is still going to be 16 baht?
So actually, to clarify your question, to clarify our slides here, so the impact on the current rate is actually on the current rate of the oil's volume growth per station. So it means that our forecast is that if there is no even oil growth due to people switching to the PTG to the EV adoption for the passenger segment, we see that there will be no growth in terms of oil volume growth per station in the period at all. So that's why it leads to the 16.44 baht.
Actually, I have another questions on the non-oil. Right? So you mentioned that they are running their own. Obviously there's a huge contribution coming from MaxMart and Pantai. That's 5 baht, more than 5 baht, right? So what made you think they can run, a coffee chain better than the professionals operators or professional operators of the convenience stores like Family Mart, Lawson? What was the differentiating point here?
As making it by DIY, it would make the PTG to generate a higher margin for Pantai and MaxMart. And with our news that we have known that Pantai is going to blend its hemp with its food and beverage, which is like the new strategy for Pantai to be differentiated and maybe has a potential to go outside the service station.
And for MaxMart, we believe that the main unique advantage will be the Max Card, which is the ecosystem that convinces people to utilize their points that they receive, which is we giving points to every liters despite of the types of the fuel that they are refueling, which is very different from
Time
the
is
industry.
up for Q&A session. Team D, please stay for the judge to give you feedback.
Okay, I'll kickstart this. So I think the presentation is good, the timing is good, slide quality is okay, it's good. But one thing though, you open your presentation with the first slide, right? Go back to the first slide, And that slide basically addressed the EV issue, right? Now the problem is the way you address the EV issue is that battery is not good enough. Longevity of the battery is not. I suggest you be extra careful with that because the R&D in this field is extremely fast moving. Right? That is a big statement that over the next 3 years, over the next 5 years, battery will still not be good enough for the EV mass EV adoption. Many people has been wrong about that. All right, so that's the first point. The second point is about your last answer, your answer to the last question, which is about the hemp, right? That is, I think there's some development going on with the company right now, right? But if you were to get to represent in the regional round, be extra careful with that because what you're saying that is that you're going to mix hemp, right? Into the coffee or into the product that you sell in the gas stations, and your main client is basically a truck driver or a pickup truck. These are drivers, right? They drink your product and go back on the road. So be extra careful with that. All right.
A few things. I think first of all, I like when you talked about risk. I like the fact that you focused in on kind of what's the primary one, and that you talked a little bit about the negative, and that's important because we're trying to understand. You can see that I was honing in on the weighted average cost of capital concept. I'm afraid that when we look at valuing a company that's highly leveraged, sometimes it's like a distressed company, and the capital structure can change very quickly over the next, let's say, 3 years. So the question is, do you use the capital structure that the company has right now, or do you set some target capital structure that's farther out in the future? I would say that you set some target capital structure. If that was the case, your WACC would be a bit low, and that could bring down, and that's what I was asking about. So there's a vulnerability. It's not only yours. The other team had a similar vulnerability. Also, unfortunately, I couldn't read some of your slides. I just couldn't read some of the charts, so that hurts. The last one that I just want to mention about is this, the accounting change. And when he asked you about the accounting change, you said you didn't include it in your numbers, right? And he accepted that answer pretty well. And I think that, in fact, I would say you answered it right in the sense that, remember, accounting is just a lot of rules. But when we value companies, we value them based upon economic value. So the market participants, yeah, accounting rules will sometimes cause some small changes, but over the long run. So I just want to commend you for that answer.
Thank you so much.
Just some comments just on the presentation. Generally quite good. Just some ways to make it better. At the end, you closed on the summary slide. Good to go through again what are the key drivers, like what you say at the beginning. You have a minute and a half to go in your presentation. You can spend some time just to reinforce your message. The second point, on the flip side to on the comment about EV, similarly, it's more on the oil, your view on oil, that for the next 15 years, oil is still king. That's a bold statement. Again, just be careful because some people can see it a different way and can challenge you. Again, it's very difficult to forecast issues like this, along with Thai baht and oil prices. So be careful.
Yeah, thank you for a very good presentation. Yeah, again, I think you focus too much a bit on the EV issue, but yeah, it's good to mention it on the rest. But the good thing for your team is that you have the implication for the higher ESG score, which is, draw more fund flow. Yeah, that's good. Thank you.
Thank you so much.
Thank you, the judges, for your feedback, and thank you, Team D, for your presentations. Now, our team have finished the presentations, and we're going to finalize the total score received from the judges, and we'll resume again around 11:25 or 11:30 for the winner announcement and award ceremony. Thank you. Honorable judges, ladies and gentlemen, now is the last sessions for CFA Research Challenge final round. First, on behalf of CFA Research Challenge team, I would like to congratulate all participating team for your hard work over the past 6 months. 6 months is definitely a long period to be in a competition. Staying focused, managing between study, work, and research challenge is not an easy task. There were teams who gave up before. But luckily this year, we are impressed that our team have completed the research and submit the quality report to us. We really do hope that this challenge is a learning and maybe a self-discovering experience for all of you. Before we announce our winner, I would like to invite Kun Win Prompat to give participation certificate to participating teams who have put their hard work into the competitions. Next, it is the time that all teams are waiting for, and the score are politicals. We will first announce the 2 finalists, which equivalent to the second runner-up, and then we will announce the first runner-up and the winner team. The 2 finalists are Team A from Thammasat University Faculty of Economics International Program and Team D, Chulalongkorn University Bachelor of Business Administration. Please come up on stage to receive the award from Kun Win Prompat. Congratulations, Team A and Team D. Now it is time to announce the winners of the research challenge in Thailand. I will announce this year winning team, so the other team will be the first runner-up. And the winning team of CFA Research Challenge for the year 2020 and to 2021 is from Team C, BBA Thammasat University Bachelor of Business Administration. Please sit first. And so the first runner-up will go to Team B. Congratulations, Team B from Assumption University for the first runner-up. Please come on stage and receive the award. Thank you. And now it's your turn, Team C. Please give another round of applause to our winning team. From Thammasat University, Bachelor of Business Administration. Please come on stage to receive the award. The winning team of CFA Research Challenge in Thailand 2020 to 2021.
ขอเชิญอาจารย์ด้วยนะคะ Congratulations all. On behalf of CFA Society Thailand, I would like to invite our chairperson of Research Challenge in Thailand to present a token of appreciation to our judge. Please welcome Kun Pasawut Virayniran. We would like to thank our judge for sharing useful feedback and asking challenging questions with our contestants today. Everyone, please join me in welcoming our judge onto the stage. Please. All right, guys, so let's have a group photo with all teams. Please come to stage one team at a time. Can I have the two second runner-ups? Please come to the stage. Okay. Can I also invite advisor from these two teams to join them on the stage, please? Thank you. Next, may I have the first runner-up? Okay, and the winning team. Thank you, everyone. Please take a seat. Everyone, please take a seat. All right, we have come to the end of our program today. To keep updated with all of our events, please follow us on CFA Society Thailand and CFA Institute Research Challenge Facebook page. Thank you all for watching, and we hope that you guys have enjoyed our research challenge today. Hope to see you again next year. Thank you.